Hello aspirants, I'm Karthikeyan from Inkar IAS Academy. Today we are going to discuss about the 6th of February current affairs. The topic taken from the daily edition, the topic is a budget that is mostly good but with one wrong move. We can see the overview of this budget. In this topic, we are going to discuss about what is the budget and what are the key aspects of budget and each and everything about that. What are the capital expenditure and what are the budget introduction and what is the tax revenue structural shift and what are the government expenditure that need of AA investment and also a major contention of the budget departure from the fiscal deficit which glide the path, and also there is an ambiguity in the debt reduction strategy, risk of high government borrowings with crowding private investment, and also there is a recommendation for a more transparent fiscal policy. This topic we are going to discuss in this topic. These are the topic we are going to discuss today. First of all, why it is in the news. One of the measure indicated that budgets could have been implemented even earlier, moving away from the fiscal deficit as an indicator in an incorrect step. A overreaching aim to budget was to accelerate the growth, pushed India towards a developed country status. The required rate of legal growth to achieve this is estimated differently, including the rate of 8% in the economic survey for 24 to 25. In any cases, the country needs a definite pickup in the growing rates, and also there is a various measures that indicated the budget were welcome. In fact, some of these could have been implemented even earlier. The concession given to the middle class in terms of income tax is welcome a relief, but is a impact and demand depends on the marginal prosperity to consume the household who are expected largely benefit from these concession and their consumption basket. First of all, the budget context. The budget plays a crucial role in shaping the Indian's economy as a trajectory. In 25-26, budget aims to accelerate growth, improve tax structure, and promote the fiscal consolidation while addressing emerging economic challenges. It is important to examine the key aspects of the budget, including the GDP projections, government expenditure, tax revenues, and also concern regarding the fiscal transparency. First of all, the budget, economic growth, and capital expenditure. One of the most significant aspects of the budget is the projection of the nominal GDP growth at 10.1 percentage in the year of 2025 to 26, which is very reasonable given the economic survey estimate the real GDP growth between the 6.3 to 6.8. The government strategy which focus on increasing capital expenditure, which gives a critical driver of the economic development, because the 2025 to 26 capital expenditure is estimated 11.2 lakhs. That is a slight increase from the 11.1 lakh crore. 25-26 capital expenditure is estimated 11.2 lakh crore, a slight increase in the 11.1 lakh crore allocated in the previous budget, while the increase in the relative models, the government that is aimed to sustain growth by boosting the infrastructure and also the industrial development. However, Indian aspiration to become a developed economy, higher growth rate around 8% in real time is necessary. So, the budget introduced the measure of stimulate economic activity. Although some policies could have been implemented earlier for greater impact, there is a many tax revenues and structural shift. There is a key. The budget is a shift in the structure of gross rate revenues, that is GTR, from indirect taxes to direct taxes. Over the recent year, the share of direct tax is GTR has increased from 52% 21 to 22, 59% in 25 to 26, which is a considered a positive development despite of the structural improvement. Tax revenue growth has been declining. The GTR growth has fallen from 13.5% in 23-24 and 10.8 in 25-26, and also there is a GST revenue growth has similarly declined from 12.7 percentage in 2023 and 10.9 in 25-26, and also there is a personal income tax growth has slowed from 25.4% in the 23-24 and now 14.4%. That partly due to the new tax concession. There is a Corporate income tax, mainly the budget is particularly low at 7.6% in the 24-25. It has been projected to recover the 10.4% in 25-26. Despite these declines, the assumption about tax revenue growth appear realistic. Now we consider the government expenditure and need of AI investment. The budget is also emphasized that fiscal consolidation is leading to reduction the government expenditure, that is a GDP from 14.6 to 2024 and 14.2 in 25-26. The total expenditure growth, that is 7.6%, which is lower than the GDP growth of 10.1%. The quality of expenditure is largely improved, and also there is a one critical area for the development, that is investment in the artificial intelligence sector. The budget recognizes that India needs to develop AI capabilities to remain competitive globally. Countries like China, United States has made the significant strides in the AI investment. With the US recently announcing $500 billion AI infrastructure is a plan. In contrast, India's technology, the struct sector, has lagged behind. The government should incentivize the AI research and development through the tax concession. A major contention in the budget announcement. First of all, concerns over the fiscal transparency, that is a departure from the fiscal deficit glide path. The fiscal deficit, the gap between the government revenue and expenditure, is a crucial metric for evaluating the country's financial health. In the medium term, fiscal policy strategy statement in 24-25, the government has outlined a clear glide path to reduce the fiscal deficit to below 4.5% of the GDP in the year of 25-26. However, the 25-26 budget, the government has abandoned the explicit target that instead of the stating focus will be reducing the debt or GDP, and also ambiguity in debt reduction strategy. A new approach focus on the alternative debt to GDP reduction path rather than the specific fiscal deficit target. That budget document presents three different scenarios, that is a debt to GDP reduction based on the varying GDP growth assumption in 10.0, 10.5 and 11. The different level of fiscal consolidation, that mid, moderate and high. The method introduces a greater vagueness in the fiscal planning process. The government does not specify a clear fiscal deficit target for each year, making it difficult to evaluate the progress. And also alternative scenario do not provide a definite commitment to how quickly the government will reduce the debt burden. So these are the main concerns. The reliance on optimistic GDP growth assumption up to 11% will increase the risk of the debt reduction projection may not materialize. It actual growth falls short, and risk of high government borrowing and crowding out private investment. One of the major consequences, that unclear fiscal deficit target, the potential for higher government borrowings, which could lead the crowding out of the private investment. When the government borrows more than the domestic financial market, it reduces the pool of available funds to private companies to borrow at affordable interest rate. We can lead a higher borrowing cost for business, discouraging the private sector investment is critical sectors such as infrastructure, manufacturing, and also technology. And also, there is a reduced private investment can slow down the economic growth, which contradicts the budget objections and achieving the high and sustainable GDP expansion. There is many impact on the credit ratings. First of all, there is a fiscal transparency play a crucial role in determining the India's sovereign credit rating. The international credit rating agencies such as Moody, S&P and Fitch that closely monitor fiscal deficit trend in debt sustainability. The fiscal deficit target, the unclear or absent rating agency may perceive as a weak commitment to the fiscal discipline. So, to maintain the investor confidence, the credit worthiness, the government should reinstate a transparent fiscal deficit target framework, providing a clear roadmap of achieving both the deficit reduction and also the long-term debt sustainability. There is a many recommendations for this more transparent fiscal policy. First of all, reintroduce clear fiscal deficit target. Instead of relying the solely debt to GDP projection, the budget should restore annual fiscal deficit goal, ensuring better accountability, and also provide a detailed debt reduction strategy That is, government outline the step-by-step plan to reduce the debt and also present the multiple alternative scenarios and also ensure the realistic GDP growth assumption. That is, a fiscal planning should be based on the conservative growth projection, avoiding the overestimation that could lead to fiscal slippages, and also limit the government borrowing to avoid crowding out private investment. The fiscal consolidation effort should prioritize reducing the fiscal deficit, preventing the excessive public sector borrowing that could hinder the private sector growth. And also, we need to strengthen our transparency and budgetary disclosures. The budget should provide more detailed breakdowns of expenditure, revenue forecasts, and borrowing plans that improve the public trust and investor confidence. So finally, the union budget in 25-26 present a well-structured approach of the economic growth, tax reforms, and also the fiscal consolidation. While GDP growth projections are reasonable, the capital expenditure need to be increased further in to sustain the long-term economic expansion. The move away from the transparent fiscal deficit target raises concern about accountability, but fiscal policy should remain clear and specific, ensuring that government meets its target without creating uncertainty in financial market. Thank you so much.